Hey guys, Taylor with GammaEdge here coming at you with post-market recap for March 19, 2025. Today, Jay Powell spoke after 2 p.m. You can see where, he started talking, no idea what he said. Just know what our tools told us. So before we get into price action today, let's go through our pre-market routine real quick. So starting with our market trend model, which is the gauge of trend and momentum in the market. It's built off the tick index, right, which measures upticks versus downticks in the market. So if the market is upticking, we're going to be moving higher. If the market is downticking, we're going to be moving lower. And it's a composite of multiple exchanges, that being the NASDAQ, NYSE, and the American Exchange. And the cumulative tick right here, which is the bolded white line, we're just creating a time series of the intraday tick. So we can look at the day over day tick and understand kind of the trends in the market. And so since last Friday, we had a nice impulse higher through Monday. Yesterday, nothing more than just a consolidation day, kind of a pullback within the context of a short-term uptrend. And then today was fairly muted, right? But in the afternoon, we did get a ramp up. We are now trending, again, kind of resuming that short-term uptrend higher. This short-term moving average ribbon, which is a set of this kind of faded 3 white lines. We call these the railroad tracks. An ideal bullish kind of foundation is the cumulative tick trending higher. Railroad tracks also trending higher. That's exactly what we have right now. So in the short term, that remains to be constructive. The only disappointing thing that we can say about today is just there is really a lack of significant buying. What this is right here is we call this the filtered tick, this cyan line, and it measures plus or minus 1,000 tick readings. That's the only way that this will register. So, we started seeing some significant buying here, but relative to say Monday, when we saw this huge ramp, there was really not that ramp coming. But nonetheless, this still looks constructive. So, in the immediate term, cautiously bullish is what we would say. However, when we're about to go look at the SPX structure, you'll see why we are very cautious. So after understanding trend momentum in the market, we then want to understand what structure in the SPX market looks like. Reason we look at SPX is because this is where the most activity in terms of options market speculation occurs in the market. And so we break out the SPX between SPXAs and the SPXPs. SPXAs is the AM settlements. That's your monthly and your quarterly expiration. This is where the institutions tend to position in longer term capital. So you can think of this as kind of a cruise ship, and then SPXP, which we'll get to next, that is where your 0DT and your weekly expirations are. So that is much more of a kind of trader's instrument is the way that we think about it. It's much more kind of short-term in nature, turns over a lot faster. So, right, that's the reason that we treat these separately. So SPXA you can think of as a cruise ship, and SPXP you can think of more as a kind of cigarette boat. Nonetheless, looking at SPXA, all we see is red, right? That just means put dominated. So put dominated structure, this is not conducive for a bullish environment. So yes, the tick was constructive higher, but SPX, the SPX complex in general is just not supportive of that yet. Ideally, there is confluence between calls or building in the structure, meaning call speculators are coming on and or put speculators are leaving, and then we're seeing that bullish impulse higher. So really what we're focused on is a build out below spot price of an exiting of out of money put speculation, and that just leaves that exposes in the money call speculators to build that bullish foundation. And then overhead, we really want to see that out of money call speculation come back into the market, right? Because it's our belief that speculators speculate with out of money positions. They're not buying 70 to 100 delta options, right? They want that convexity. And we see that time and time again. The market goes through cycles or sine waves. And right now we're kind of at the bottom of the sine wave. So we're wanting kind of a thawing of the put conditions, and we start to make our way back up to sine wave where out of money call speculation comes in. Next one, we're looking at SPXP. Again, this is a cigarette boat, right? What we see is, again, no real call speculation to speak of in the complex, right? So again, what we want to see is out of money call speculation come back into the market. As an example for you, looking back on 129, again, the quick plug, this is just from our newsletter. You have access to all these, prior dates. If you want to subscribe to that, it's free. But anyways, look how this is a call dominated environment. This is much different than where we're at right now. You see call deltas, green deltas everywhere. And then right now we are nothing but red. So again, very easy to see what the structure is and who's dominating and why we feel the way that we do about the markets right now. So once we understand kind of on a broader context where we are in the market, that is the market trend model, right? And then we're looking at the full complex of the SPXA, SPXP. Swing traders, you can more or less stop there because we understand right now, okay, the environment is not very conducive. At least coming into today, it was not. Now, after today for swing traders, we started seeing that bullish expansion a little bit in the market trend model. So sure, we could put on some, tester positions, certainly not going significant size by any means, because given what the SPX complex looks like. But as we start to see that thaw out, then perhaps we could be putting on more and more exposure. But that is yet to be seen. However, for the SPX intraday traders, 0DT traders, we then go and we focus specifically on the 0DT complex. This is also somewhat relevant to swing traders, right? Because we believe that every trade starts as a day trade. So we need to be seeing kind of positive progression in order to maintain that trade. So everything in our analysis when it comes to 0DT starts with our transition zones. Transition zones you can simply think of as areas where there are congestion in the market and there is not an agreement between call and put speculators on who is in control of the structure. So there's three primary transition zones that we look at. Some have more significance than others. Going from least to most important, starting out with the GammaEdge transition zone. This is based off of Gamma. This is the white box here. We can see that transition is from 56.45 down to 56.15. And again, just within these transition zones, we expect choppy price action. And once we start to break through either side of that, then that's where we expect to see trending moves form, and that's where our intraday volume analysis comes in that we will hit on after this. So once we have the GEX transition zone, then we look at the delta or the DEX transition zone, and that is the blue box, and that was from 56.70 down to 56.15. So the thought process here is, hey, okay, if we can break through the GEX transition zone, then we would be looking for some kind of move up to 56.70, which is the top of the DEX transition zone. However, keep in mind, it's still within the context of the broader transition zone. So this is riskier long because, again, we're still within the transition zone. And within here, we expect chop, and price action is much more dictated by intraday volume and how speculators are transacting, as opposed to the dealer mechanics and the moneyness of options taking over. So again, once we have the DEX transition zone, then we move on to the drunken sailor range. Drunken sailor range is this yellow box right here. And the way that you can think about this is, yes, while we do break through the top of DEX transition zone, we are still in an area where there is limited kind of call dominance. So volume still plays a very important role to push us out of this drunken sailor zone. Once we can get above 5,700, then that's really where the call dominated options, the moneyness of those options really starts to have an effect on price itself, to where you don't need as much volume coming through to push price higher. And the same thought process goes to the downside as well. So that would have been below 5,600. So now that we have that established, these boxes on the chart should make a lot more sense. Just to recap, the black bordered box, that's our GEX ratio. The blue box is our DEX ratio. The yellow box is our drunken sailor zone. So the natural progression kind of makes sense, right? So just replaying price action real quick before getting into the volume stuff, we can see that the DEX transition zone did a pretty good job of maintaining price until Jay Powell spoke. And once he spoke, kind of price is going to do what it's going to do. But in the morning, backing up, one thing to note real quick is these are not like specific levels, right? They're more like zones. I say that just to say, because someone's going to say, oh, the bottom of the DEX transition broke, we should have dumped, right? And it's like, no, it's just an area. It's kind of like a sponge, right? So we need to see conclusive, evidence of us breaking through it before we can kind of definitively say, yep, that level is broken. Nonetheless, there were two trades that I personally took in the morning. I just mentioned that because, we are on voice chat in the Discord live. We are talking through what we were seeing. So just want to, let you guys know that we are actively trading on our tools as well, putting our money where our mouth is, per se. Right? Because we don't have a formal background on this stuff. At the end of the day, we're just traders trying to make money. These are tools that we've developed for ourselves. And, we created the community, A, to collaborate, and B, just being transparent because we need help paying the AWS bill because it is quite hefty and developers are expensive. So the first trade, I took it, out of GEX transition, expecting to make this move higher. However, we started chopping around prior day highs, just took profits off right there. The reason being is because we weren't kind of maintaining that kind of rapid progression higher. And once we hit on volume in a second, we were just not seeing any material volume build to the upside. Just getting to that now, this is what it looked like at 11 o'clock when I took the trade off. So for those that are not familiar with this, what we do is we track intraday volume on the SPX 0DT complex. Reason for this is because this helps us understand sentiment in the market. So just going through this chart real quick, what we do is every 5 minutes, we look at the distribution of call and put volume, and we create centroids, which is, you can just think of it as the middle of the distributions. We do that both on the call side, which is this thick green line, and the put side, which is this thick red line. Every 5 minutes, we plot where that centroid is. We connect the dots for you. So then we can start to make kind of trends of what the sentiment and how speculators are transacting on the day. The reason that's important is because if we understand how they have been transacting from the open until a certain point in time, then we can kind of infer, all things equal, and they continue to transact in the manner that they are, that price will continue along that path and will eventually settle there. Just to make that tangible, this is what the vol M chart looked like at 11 o'clock, the time frame I was referencing. So you can see we call these are lines of best fit. They're essentially linear regressions based off of the centroids plotted today. So you can see how these crisscross, which effectively indicates choppy price action. Like those calls and puts and trends aren't actually going to cross throughout the day. We just have limited data points. So that's the way that they move. But throughout the day, you know, the call volume is going to stay above spot price and the put volume is going to stay below spot price. And, you know, all things equal, assuming that they continue to transact how they are, then these lines of best fit are going to eventually move up, and it's going to be kind of a choppy day, which is exactly what we got. So just playing through the rest of the day, again, right, what I was talking about, the centroids, you know, continuing the, you know, call stay above spot price, put staying below spot price, and it was a fairly choppy day all day today, really no meaningful advancement in the call side or the put side. Yes, we did get a ramp in the puts here, but again, the calls were very kind of had a cap on the market throughout the session, right? One interesting thing that I did want to note today is this rejection up here at, you know, essentially 5,700. The reason that this made sense is because all session on the call side, right, the majority of calls were placed here. They were placed out of the money, right? And so once price came up here to where the majority of those calls that were placed, those calls went from out of the money to now they're at the money. So all of that out of the money risk has been captured by those speculators. And so this is kind of a natural place for them to monetize that position. Additionally, that somewhat corresponded with our drunken sailor range. Again, remember this is a sponge. So once we made it to the top of the drunken sailor range, we needed to see a continued upward thrust of volume to help us propel us through that zone and to continue higher. And we did not get that in a meaningful way, right? Because we can infer that there was some monetization of those positions put on early in the session. Once they got to at the money or even slightly in the money, then those profits were taken. We are also getting towards the end of the session as well. So hopefully that makes sense. The one other thing I wanted to run through real quick is just a second trade, just so you can see how we use the system. Again, was not taking trades after the JPOW stuff just because, you know, price action can be a bit erratic after news events like that. And so the second trade taken today happened right here when we retested the top of GEX. This was a great spot in my mind to put some risk on. A, because I could define my risk that right here at the low of the day. B, this is a higher low. And so assuming, you know, we could hold this, that is kind of a a bullish price action, right? And the play there was from the top of the GEX transition to the top of the DEX transition. Now, this position was size smaller than normal because, again, we were within the context of the DEX transition and within the context of the drunken sailor range. So choppy price action like this earlier trade is very possible in this range. Additionally, for those people out there that like to use, you know, some basic indicators, this spot where I put the trade on was right where VWAP for the day was. So we had a little bit of confluence there. Again, another way to easily size risk. You know, if we break through VWAP, break through that potential higher low, then that is just an easy place to get out of the trade. And then you can see really took no heat on that trade. And I mean, it pretty much painted top of DEX transition zone to the sin. So you can see the utility in having these levels on your chart, right? Because they're not really price action based levels. They are based off of structure and market generated information. So that's why, you know, following the options market is very important. Yes, I'm biased because that's what we do, but also, a significant amount of activity today is concentrated in the options market. The last point that I wanted to make real quick was for the swing traders out there. Every day we have two key scans. We have a call dominated scan and a put dominated scan. Call dominated scan means that structure is call dominated above and below spot price. Remember those SPX dashboards we looked at? And then our put dominated scan is vice versa. We just have both put dominated above and below spot price. And so the reason I look at that is kind of from a sentiment point of view, but then also as we're starting to get expansion of the tick higher, I want to see what stocks are call dominating, kind of have a bullish structure. So from a sentiment point of view, we can see that a lot of these stocks are more defensive in nature. We have a lot of consumer staple stocks, we have China stocks, and then we have a lot of ETFs such as emerging markets, gold miners, things like that. We really don't have any of those high beta names in here. So from a sentiment point of view, that's just kind of another important data point. So with that, appreciate the time. Hopefully you find these post-market videos that we've been doing recently helpful. If so, leave a comment, leave a like, something like that, just so I know that you are getting value out of this. And so I continue to put some of my time at night to doing those. So with that, have a great night, and we'll see you all tomorrow. Bye.